This is an Uncovered Japan Company research report on Rengo Company Limited, ticker 3941. Rengo invented Japan's corrugated box in 1909 and still makes roughly 1 in 4. Its integrated chain turns recovered paper into containerboard, corrugated sheet, and finished packaging. The investment question is whether that durable position can produce better margins and returns under the Vision 120 plan. The report is dated June 11th, 2026, with market data as of June 10th. At that point, Rengo traded on 11.1 times forward earnings and 0.7 times book, with a 2.88% dividend yield and 6.5% return on equity. These figures look inexpensive in isolation, but the report finds the earnings multiple near the top of Rengo's own recent range and the book multiple above paper sector peers. The product is easier to understand as a loop. Rengo buys recovered paper, makes containerboard, laminates corrugated sheet, cuts and prints boxes, delivers them, and brings fiber back into recycling. The report records a recovered paper utilization rate of 98.6% and about 25% of Japan's corrugated market. Integration captures several stages of value and gives customers a dependable packaging and logistics partner, though it also creates a heavy, fixed cost base. Rengo's 5-year income statement shows the central problem. Revenue rose almost 46% to 993 billion yen, but much of that growth came through acquisitions. Operating profit did not compound with sales, and the operating margin fell from 5.9% to 3.8%. Recovered paper, energy, freight, labor, and depreciation costs ran ahead of price increases. Vision 120 exists to reverse that gap between scale and profitability. The segment chart separates the dependable core from the turnaround work. Paperboard and paper processing represents 52% of sales and most operating profit. Overseas is already 22% of sales, but earns only a 2.3% margin, partly because Europe is weak. Flexible packaging is another 18% of sales at a 2.8% margin after a major integration. Those two low-margin businesses decide whether the group can reach its targets. Operating cash flow remains substantial, at 77 billion yen in fiscal 2025, but free cash flow was negative 20.3 billion after heavy investment. That can be rational during a planned capacity and integration phase, yet it raises the burden of proof. Investors should watch whether capital spending produces better overseas and flexible packaging margins, and whether free cash flow turns positive as the Vision 120 investment peak passes. Rengo's advantage is a durable operating system rather than a luxury margin. National scale, the full paperboard to box chain, in-house logistics, and customized printing make it costly and risky for large food, beverage, cosmetics, and electronics customers to switch casually. The recycling loop also stabilizes fiber sourcing. Still, this is a capital-intensive device industry. Energy, freight, and raw material pressure can overwhelm pricing for a time, so the moat protects relevance more clearly than returns. Management's capital allocation plan illustrates the balance between growth, leverage, and shareholder return. Vision 120 allocates 320 billion yen to capital expenditure and acquisitions, 250 billion to debt repayment, and 60 billion to dividends. Rengo's progressive dividend has not been cut in a decade and was raised to 40 yen, but its yield and buybacks lag some peers, leaving room for stronger capital returns as cross-shareholdings are sold and debt comes down. Vision 120 targets 1.2 trillion yen of revenue and 70 billion yen of operating profit by fiscal 2030. The strategic direction is credible because management explicitly acknowledges that past growth did not deliver adequate profitability. The less proven assumptions are lifting overseas margin from 2.3% toward 5.3% and realizing synergies in flexible packaging. If both improve, the group can re-rate. If either stalls, scale alone will not solve the return problem. Rengo's 0.7 times book multiple is eye-catching, but context changes the conclusion. The report's 11.1 times forward earnings multiple sat near the top of its 5-year range, and the price-to-book ratio was actually above the selected paper sector average. Investors already pay a modest relative premium for leadership, integration, and dividend reliability. A further re-rating therefore needs operating margin proof, higher return on equity, or a more forceful response to Tokyo Stock Exchange pressure on below-book companies. These are the report author's scenarios, not price targets or investment advice. From the 1,390 yen reference price, the fiscal 2028 bear case is about 42% lower, the base case about 6% lower, and the bull case about 47% higher. The range reflects the sensitivity to margin recovery and valuation. A separate near-term risk is the report's extreme credit long-to-short imbalance, which can create future selling pressure even if the business develops as planned. To conclude, Rengo combines a genuinely durable franchise with modest current returns. Its leadership in corrugated packaging, integrated recycling loop, and reliable dividend are real strengths. The trade-offs are equally visible: thin margins, heavy investment, leverage, and a valuation that is less cheap than the book multiple first appears. The key indicators are overseas and flexible packaging margins, free cash flow, return on equity, and capital returns. For the complete evidence and assumptions, continue with Uncover Japan's free deep dives. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security.